The 1998 economic crisis in Russia. The inability to meet the terms of a loan obligation, or the failure to repay a loan in the name of one of the causes of the crisis, was one of the worst economic crises in Russia. History of Russia. The financial crisis in Russia was initially triggered by the Asian crisis that led to lower prices for raw materials, oil, gas, metals, on which Russia was 80% dependent. Against the background of declining revenues, this country has found itself in the situation of no longer paying its foreign honors, entering into cessation of payments. Before 1998, the government issued bonds to cover its deficits, and when these bonds reached maturity, they were paid by issuing new bonds, thus the debt being rolled. The interest paid by the government for these bonds had at one time reached 150% per annum. This whole pyramid scheme collapsed on August 13, 1998, when the stock market and the exchange rate collapsed. The economy began to recover in 1999 to 2000. The causes of the crisis from the point of view of the international economy. The financial crisis in Russia, the ruble crisis, broke out with the brutal devaluation of the Russian ruble in August 1998. The causes were also numerous in this case. Its emergence was influenced, among other things, by the international contagion of that period following the Asian crisis of 1997. In addition to the decline in world commodity prices, Russia has seen a decline in productivity and a chronic fiscal deficit. Economic growth was also affected. To these was added the huge cost of the Chechen War. The financial crisis has led to an economic crisis with the government announcing its inability to pay its debts. The structure of financial markets in turn favored the emergence of the crisis. Market-based financing was low compared to that achieved through banks, and the government bond market was much more developed compared to that of private bonds. These observations highlight the absence of a history of corporate lending. Other observations related to the financial system are: enterprises are financed mainly by banks, whose source of financing is mainly deposits. Banks' securities portfolio is not diversified, with most securities being government bonds. On August 13, 1998, Russia's financial markets collapsed as a result of investor fears that the government would devalue the ruble and fears that Russia will become insolvent given the evolution of international reserves. Stock prices fell dramatically by up to 65%, prompting authorities to stop trading securities. On August 17, the government and the Central Bank of Russia issued a joint statement announcing widening the fluctuation band of the ruble against the dollar from 5.3 to 7.1 rubles per dollar to 6.0 to 9.5 rubles per dollar. Russia's debt denominated in national currency will be restructured in a way that will be announced later. A temporary moratorium of 90 days will be imposed on the payments of certain debts of the banks, including debts resulting from forward contracts on the exchange rate. The central bank, CBRF, repeatedly intervened in August 1998 by allowing banks to use required reserves to make payments, provided a stabilization of loans to troubled banks, and guaranteed deposits with the state-owned bank Sberbank. In total, the central bank increased its lending to commercial banks 6 times over a 10-month period since June 1998. Although the liquidity injection was made before the crisis broke out, the turmoil could not be avoided. The IMF and the World Bank have again intervened by providing $22.6 billion in financial support to support reforms and stabilize financial markets through swap operations on a huge volume of government bonds (GKOs) maturing against euro bonds. Long-term, the reforms have had a positive impact. It can be said that this crisis, unlike the previous ones, had the effect of correcting the economic imbalances. In the theory of the international economy, The concept of impossible third implies the impossibility of establishing the fixed exchange rate situation, the free mobility of capital, and at the same time an independent monetary policy. In Russia, the ruble-dollar rate was fixed. The free movement of capital allowed foreign companies to invest in the GKO market. Monetary policy was aimed at controlling inflation. In such a situation, if there is an overvalued currency, the real exchange rate of the ruble for $1 was very high, there is a strong speculative attack on the currency. In the case of Russia, the pressure has passed through the GKO market, with its high rates irrelevant to inflation. As a result, declining foreign exchange reserves forced the government to devalue its currency by default. Possible crisis scenarios. In 1998, the Russian state had three opportunities to get out of the crisis: print money and pay GKO, thus starting the inflation mechanism; announce the default status, inability to meet the terms of a loan obligation or failure to repay a loan for the external debt; announce the default status, inability to meet the terms of a loan obligation or failure to repay a loan for the domestic debt. The third option was chosen. The alleged reasons for this choice are the following: the experience of hyperinflation in the 1990s was quite recent, and the launch of a new inflationary spiral was not considered valid. Non-payment of external debt was also considered unacceptable for Russia, even in the dynamic process of changing power. The uniqueness of the 1998 crisis in world history. Russia's inability to meet the terms of its 1998 loan obligations came as a surprise to Western investors, guided by the "Russia it's big, it won't be let down" principle. However, history knows of such situations of loan defaults in much better developed countries, such as France. The characteristic element of this crisis is the fact that in the history of the world there have not yet been cases in which the state has announced its inability to pay the loans on the domestic state debt expressed in the national currency. In the case of Russia, a default was declared on GKO, whose yield immediately before the crisis reached 140% per year. A common practice in other countries in similar situations was that the state began to print money and, thus, by depreciating the national currency, debts were amortized. Investors, who have invested considerable funds in the GKO market, were expecting such a scenario to unfold in subsequent events. Consequences. Foreign investors began negotiations with the Russian government, but GKO payments assumed a miserable amount of about 1% of the debt. The major losses were borne by CSFB, which controlled 40% of the market. Its consequences have severely affected the development of the economy and the country as a whole, both negatively and positively. The ruble rate against the US dollar has fallen in 6 months by more than 3 times from 6 rubles for a dollar before default to 21 rubles for a dollar on January 1, 1999. The confidence of the population has been undermined, and foreign investors in the Russian state and in Russian banks. A lot of small businesses went bankrupt, many banks simply exploded. The banking system has been collapsing for at least 6 months. The population has lost much of its savings, and the standard of living has dropped considerably. However, the devaluation of the Russian ruble has allowed the Russian economy to become much more competitive. The devaluation of the currency has led to a significant reduction in the import situation and an increase in exports. Russian companies, which had costs in rubles and exported goods, became competitive. The consolidation of the real exchange rate of the Russian ruble was achieved within 7 years until 2005, when the exchange rate reached the indicators of 1996 to 1997. However, the negative effects of the crisis had significant costs, with the crisis in Russia contributing to other episodes of turbulence. Begg points out that the negative effects of the crisis in Russia had repercussions in several neighboring countries, leading to a decline in financial transactions and a reduction in GDP growth in Hungary and Poland in the first months of 1999. According to the Russian economist, president of the Institute of Energy Policy V.S. Milov, despite the negative impact on the welfare of the population, Consequently, the crisis played a favorable role in the economic development of the country for the reason, first of all, the rapid growth of fiscal discipline in the post-default years,